To kick off the 9th annual Faculty Chalk Talk lecture series, I'm here to introduce Matthew Slaughter, our Associate Dean and the Signal Companies Professor of Management at the Tuck School of Business. Professor Slaughter is currently a Research Associate at the National Bureau of Economic Research, a Senior Fellow at the Council on Foreign Relations, a member of the Academic Advisory Board of the International Tax Policy Forum, an academic advisor to the Deloitte Center on Cross-Border Investment, a member of the U.S. State Department's Advisory Committee on International Tax Policy Forum, and obviously a very busy man. From 2005 to 2007, Professor Slaughter served as a member on the Council of Economic Advisors in the Executive Office of the President. In this Senate-confirmed position, he held the international portfolio, advising the President, the Cabinet, and many others on issues including international trade and investment, currency and energy markets, and the competitiveness of the U.S. economy. He has also been affiliated with the Federal Reserve Board, the International Monetary Fund, the World Bank, the National Academy of Sciences, the McKinsey Global Institute, the Institute for International Economics, and the Department of Labor. Professor Slaughter's area of expertise in the economics and politics, is in economics and politics of globalization. He has testified before chambers of the U.S. Congress, and he contributes op-eds to the Financial Times, the Wall Street Journal, and the Washington Post. His ideas are regularly featured in Business Week, The Economist, the New York Times, Newsweek, and Time Magazine. And at Tuck, he co-directs the flagship executive education program, Global Leadership 2020. Prior to joining the Tuck faculty, Professor Slaughter, since 1994, had been on the faculty of the economics department at Dartmouth, teaching undergraduates. In 2001, he received the school-wide John M. Manley Huntington Teaching Award. He received his bachelor's degree summa cum laude and Phi Beta Kappa from the University of Notre Dame in 1990, and his doctorate from the Massachusetts Institute of Technology in 1994. Today's talk is entitled, In the Wake of the Financial Crisis, What Next? Please join me in welcoming Professor Matthew Slaughter.
Thank you. So thank you for that kind introduction. Can you all hear me okay? Great. So good morning, everyone. Welcome back to campus. Hopefully the game will be a good outcome today. Nice weather for it. So what I thought I would do is have a conversation, and I'm happy for this to be a conversation. So if you have questions or comments or you don't understand something I'm saying, just raise your hand or just call out and I'll hear you, and we'll try to figure out kind of where the global economy is together. So I've put up here, I thought I'd call this talk In the Wake of the Financial Crisis, What's Next? I gave a similar talk recently to some Tuck alums, and the first question from one of the alums was, why did you choose the word in wake? Do you know that it's over? And so I said, well, I kind of hope it's over, but, good point well made. And so in that spirit, I will acknowledge, I'm going to say two things at the outset. My wife and I have two boys, Jacob sitting in the back there, hi Jacob, and older brother Nicholas, and for a long time, the boys, we like to read the Winnie the Pooh stories at home. And as an adult, when you go back and read the Winnie the Pooh stories, what you see is there was actually a lot of sophisticated thought that A.A. Milne put into the different characters, their personalities and things. So I'm going to say at the outset, the first thing is, by disposition, I tend to be a Tigger, an optimistic, kind of happy-go-lucky person. The 5 numbers that we're going to discuss here are not Tigger-like numbers. And I wish it were different, but in my job at Tuck as an educator in earlier days, as was kindly said, I taught the undergrads here for many years, which was great. You kind of got to start with the data. The numbers are what the numbers are. And we can talk about what the numbers are and kind of how they mean. And the second thing I'll say at the outset is I'm a long-standing registered independent, so we can talk about public policy if you like. I'm not a Republican. I'm not a Democrat. I've worked with and continue to work with members and leaders of both parties. So with that as background, I'm going to give us 5 numbers to think about with all the turmoil that has hit the U.S. and the global economy in the past few years. What are some of the big policy challenges that the United States and that a lot of other countries face? Okay? So 5 numbers, and I'll have a picture and maybe some words that go along with each number. And you guys let me know what you think about the numbers, okay? The first number is actually a date. It's January of 2020. And this number I want you to think of as a summary for how damaged the United States economy and a lot of other economies in the world still are in the wake of the world financial crisis, and in particular how damaged the labor market is, okay? So this number speaks to the damage that millions and millions of American workers and their families are still working through and facing in the wake of the world financial crisis and the Great Recession. Okay? Here's a picture of that. What I've got here is a picture of the loss in the United States economy in payroll jobs in the most recent recession that started in December of 2007. That's the black line. And in the 5 previous recessions that the U.S. economy suffered going back roughly 30 years. So I made this picture as big as I could, and the important thing to see, the black line is where we are kind of today. So when I'm tracking along the horizontal axis along the bottom here is calendar months. Every month, the first Friday morning of each month at 8:30 a.m., the U.S. Bureau of Labor Statistics puts out the employment situation report. And one of the things in that they track is the total number of payroll jobs in the U.S. economy. So what I'm tracking on the vertical axis is the loss of jobs, not in absolute numbers, but in percentage terms. So the percent of jobs that were lost from the start of each recession, counting calendar month by calendar month. So I think your eye is drawn to 2 things. One is how far down that black line goes. So that's a real indicator of just how damaged the American labor market is today compared to earlier recessions. It's not as bad as it was in the Great Depression, but it's still really bad. In the Great Depression, the unemployment rate, a number similar to this, reached up to about 20% for a period of time. We haven't been that bad thus far, but you can see this is a lot of damage. And so one question is that I want us to think about is, okay, here's some recovery. I've got here some Pooh characters. The Eeyore Period, this is in late 2008, early 2009. So the Chalk Talk series that was held 3 years ago, that was happening at the most intense time of the world financial crisis. After Lehman had died, after AIG almost died, there was terror literally gripping capital markets and a real breakdown and a massive spillover to the real economy. This period of Eeyore-type job loss, that was 800,000 jobs being lost every month. That stabilized. What we can see is some recovery happening. This tick up and then down there, that is the U.S. federal government hiring and then laying off hundreds of thousands of workers, counting the people in the 2010 population census. That's what that kind of blip up and down is here. But I use Piglet now to describe sort of where we are. We're getting some recovery, but boy, there's still a lot to be made up. And if you follow these statistics, the most recent data that we got for the month of August here in 2011, the net number of jobs created was how many? 0. None. So here's some words that summarize how bad the damage is to go along with that picture. Excuse me, getting over a cold. I'll highlight a couple things. The U.S. government counts the number of people that are unemployed and then also the number of people that are underemployed, who do have a job but who are involuntarily working part-time. They would like to work full-time in their job, but their firm won't give them full-time hours. The number of under and unemployed Americans in the United States today is about 25 million. In percentage terms, the underemployment rate is about 16.2%. The unemployment rate, that headline unemployment rate we hear a lot about, is at 9.1%. And most forecasts, given the 0 number last month, not rapid, strong job growth in anybody's forecasts. Those numbers, those percentages would be higher if it weren't true that several million Americans seem to have gotten so discouraged about how grim the prospects are in the labor force that they're not actively enough seeking work to be counted in the pool of the labor force. So what economists call the labor force participation rate has fallen by about 3 percentage points. If I added those people back in, the headline unemployment rate today would be approaching 13%. The headline underemployment rate today would be approaching 20%. And it's not just a lot of people, the spells of unemployment have gotten a lot longer in calendar time. Almost half of the people today who are unemployed in America have been unemployed 6 months or longer. And that really erodes the skills, the kind of optimism and outlook for a lot of those workers, and tends to have quite long-lasting impacts on their earnings in the future and such outcomes. And it's not just the number of jobs, it's the kinds of jobs. There's a lot of pressure on incomes in America. Just this week, the Census Bureau released their annual report on poverty. And a lot of the headline on that was on the number of people that are living below the official poverty line in America. That number increased by almost a percentage point last year to 15.1%. It's about 46 million Americans living at or below the poverty line. But if you look at the incomes earned by a household, so the unit of observation now is a household, the average household income in 2010, those of you that remember your statistics well from undergraduate days, the median household income, $49,445. That's about where it was in inflation-adjusted terms in 1996, 15 years ago. It is only $369 above where it was in 1989, 22 years ago. So it's not surprising then, when you think about the political economy of this, that the first, second, third, 18th most important thing Americans are worrying about today is jobs, jobs, and jobs. So the question is, how long does this damage last? Peak to trough thus far, the U.S. economy lost 8.8 million payroll jobs. All of that remarkably in the private sector. So that was a remarkable 7.6% of all the private sector payroll jobs. So when you look at how many private sector jobs we have today, it's somewhat remarkable. We have 109.2 million private sector jobs in the United States economy today. That's the same number we had 12 years ago in September of 1999. And real-time surveys of both large and small business owners in America, you don't see much optimism or much desire for these companies to start aggressively hiring. And until we can get a set of policies in place in the United States to do that, these numbers are going to be present for quite some time. Some people like to focus on manufacturing. There's just not enough there in manufacturing to fully fill this jobs hole that we have. We have about 11.7 million manufacturing jobs in America today. Anybody know the last time we had 11.7 million manufacturing jobs? 5 years ago, 10 years ago?
Louis, what percentage of this is your sense that it's technological in the sense that technology has overtaken the need to have people hired?
Oh, great question. So I'll answer that in a second, but just last time we had 11.7 million manufacturing jobs in America? April of 1941. 60 years ago. So the other thing I want us to show on this gentleman's excellent question is if you look at these earlier recessions, here's the recessions of the of the 70s and early 80s, these ones I'm tracing out here. They kind of have this sharp V shape. Oh, the question was, do we worry that technology is going to reduce how much firms want to hire more people in the United States today? Okay? We're thinking about what's going to happen in the economy to induce more hiring so that more workers and their families can get back in the labor force and kind of get re-engaged. So I'm answering that by pointing out these recessions in the 70s and 80s, they tended to be very sharp and short recessions. They tended to be induced, those of you that were economics majors, I'm sure you recall learning about monetary policy. It used to be because the Federal Reserve was more and more concerned about inflation. They raised target policy interest rates. That cut into spending by families and cut into capital investment by companies. You had a recession, and then people got hired back pretty quickly when the Fed relented. But notice the recession in the 90s and this recession in the 2000s, those V's kind of got pulled out along the axis here. They're more like U's. And one of the realities of the U.S. economy that folks like me who are economists don't fully understand, but we've got some insight on, is it's taking longer and longer in calendar time when we have recessions for the jobs to be built back. Part of that seems to be an acceleration of technology innovation going on. And recessions are a time where some companies adjust by putting in new capital, new fancy capital equipment, and other things that allow them to hire fewer people. Another big feature is globalization. So it seems more and more, especially a lot of large global companies, when they have recessions, part of what they do is they use that as an opportunity to recalibrate what they're doing around the world. And so part of what's happening is jobs get built back, but outside of U.S. borders, inside these companies. So if I'm thinking about time, and I'm meandering now to the first number I gave you, the big question is how long is it going to take to build back all these jobs? In the context of ongoing aggressive technology innovation, ever faster globalization, so on and so forth. If I look at that most recent recession here, the early 2000s, I lost about 2% of payroll jobs. It was 2%. And it took me 48 months, 4 years, to build back that 2% job loss. Now I've got a recession that's at least 3 times as deep in the labor market. So I'm going to take 3 and multiply it by 48 months, and I get 144 months, and I take out my calendar, and I count forward, and I get to January of 2020. That's not an unreasonable forecast for how long it's going to take the U.S. economy to get back to the number of jobs it had before the recession hit in late 2007. Maybe faster. I'm hoping it's faster, and I'm desperately hoping that we can have some leadership in Washington, D.C. and elsewhere that'll build the conditions for companies to build back more jobs more quickly. But even if that happens, practically speaking, 2016, 2017, and obviously if I get a lot of months of 0, I never get back. We're hopefully not going to be there. But think about the politics of this then, and as was pointed out, this year's chalk talks building on the presidential elections that are coming up in the U.S. next year. Boy, a lot of commentators, I think, correctly pointed out that the 2010 elections had a lot to do with jobs and how people are doing in their pocketbooks. Well, whether or not you'd like that, 2010, okay, 2012, 2014, 2016, 2018, 2020, the dynamic of the political economy is going to be present for a long time in America, and I worry about how that's going to play out. Please.
Do your numbers take into account, assuming that 2020 is the date we might reach this, the fact that there's this great big group of people out of work, and yet we are graduating kids from high school and college that are trying to enter the workforce and are not in the work, not getting it either. So there's going to be a big backlog.
So great question. So no, because I didn't want this to be a depressing number. I did not factor in the reality, which is every month our labor force grows because the population grows. That's partly young people working hard, coming through Dartmouth and graduating. It's partly immigration inflows from the rest of the world. The combination of a growing population from different forces means just to grow on the demand side, new jobs to keep up with the labor force growth, we have to grow about 150,000 jobs every month just to keep kind of even with the growth in the population and the labor force. So if I add that number back in, you can dial this number even forward, right? So how long this takes, we got to go to Wentworth, I think, if I'm going, I'm not sure which way we're facing. And I'm not faulting Congress, I'm not faulting the president. This is just a deep-seated feature of technological change, globalization. And I will say, a lot of people, they excoriate the companies today. Well, get out there and hire. A lot of companies are reasonably still worried about what happened 3 years ago. They're building up a lot of cash on their balance sheets from what economists call precautionary savings, in part because of one of the other happy numbers I'll get to in a minute, which is, the world financial crisis we're hoping is over, but what's happening in Greece and other European countries right now, no one has any idea how that's going to play out in the coming days and weeks. Nobody.
Are there some sectors that Tigger likes better than others?
Here's the thing. We got to grow. So yes, can I answer that with the second number, actually? I'll come to that. It's a great question. I'll come to that in a minute. There was a hand here.
Aren't we really dealing with the emperor's clothes here? Everybody talk about all the superficial legislative things to try to improve the economy. But basic labor force is now what? The kids are now 17th and 21st. It's the largest economy in the world with the 17th and 21st in math and science.
Yep.
You've got a very difficult position with the minorities.
So great. The question here was, do we think there's going to be some places where we got to focus on growing jobs? Great question. That's my second number. And then the comment here was, well, what about the eroding American skills, and do the companies want to hire kids and other folks in America? Great question. That's my fifth number. So you guys are awesome. Can I answer it when I'll get to number 2 and number 5 in a few minutes, right? Both these are deep and fundamental questions. Where are the jobs going to come from? And frankly, this is part of how globalization matters. we can beat up on the companies if we want, but I think a better metaphor is a lot of these large global corporations that many of the Dartmouth students aspire to work at when they graduate, many of my Tuck students, those companies have such stunningly different opportunities today than they did 5 years ago, let alone 20 years ago, because of the rise of China and India and Brazil and many brick and beyond countries. I think the better way to think about some of the challenges these companies are telling us about is they're serving as canaries in the coal mine. That's my view. They're telling us where there's opportunities to hire around the world, and the reality is the competitiveness of the labor market that the Dartmouth students today are facing is stunningly different from what it was when you all were here. Now, you might not like that fact, but it's a fact. And then the question is, what do we do in our families? What do we do in Washington, D.C.? What do we do elsewhere in the country to account for that? But folks that won't acknowledge this fact, I'm an educator, right? And part of what we do here at Dartmouth, as you recall, is we try to engage the students with great faculty that are working on scholarship and outreach. So I view my job with my Tuck students and the execs that I work with is making them aware of this and thinking about, okay, now what do we do? And I don't claim to know to have the answers, but if we don't start from this, or you want to claim this is all the fault of the Republicans or the Democrats or this member or that member, that's unproductive, to put it politely. Okay? Everybody comfortable with that first number? And like I said, remember, I'm a Tigger, and I will say this now, something I'll say at the end. As challenging as these numbers are, what I say to my Tuck students, and in different settings I say to the Dartmouth undergrads, the paradox for them to see is this presents such an opportunity for each of them because the world right now is desperate for leaders to help figure this out. So though it's a challenging environment, it is an opportunity for the students on campus here to go out into the world, and whether it's with a company, a not-for-profit organization, governments in the U.S. and other countries, there are so many organizations around the world that have an acute demand for leaders that can come into their organizations, that can understand the reality, and that can help craft stories to try to create solutions. So I say that to my students a lot, just to remind them. Okay, second number is a percent. It's 70.5%. This is a number that builds on the first one to say, on Jim's question, we got to grow jobs, but we can't just grow any old jobs. We got to try to grow, in some sense, the right kinds of jobs in America. And this is true for a lot of other countries, but I'll focus on America, okay? A lot of these numbers are going to be kind of U.S. specific, but the damage to the labor market is present in so many countries around the world. I have to go to Madrid in a few days. The unemployment rate in Madrid today, in Spain, in all of Spain, is about 22%. The youth unemployment rate in Spain today is about 42%. So it is many advanced countries around the world, mainly advanced ones, higher income ones, that are facing these kinds of challenges. We got to grow the right kinds of jobs in America. Here's a picture of what I mean. And I've got a rhetorical question up here, which is, do we really want this line to climb more? And I'll tell you right now, the answer is no. Let me explain what this line is. This line tracks for each quarter from the end of World War II up to today, how much of total output in the U.S. economy, those of you that were economics undergrads, remember that's GDP, gross domestic product, what fraction of U.S. GDP is accounted for by consumption spending? That's households buying stuff. That's families buying plane tickets and automobiles and refrigerators and fancy stoves and VCRs and DVD players and educational services like Dartmouth tuition and healthcare services. So what fraction of how much stuff we make in America is satisfying the demand of households to buy stuff? That's what this shows. So it's a percentage on the vertical axis. And I made it as big as I could, and sorry, you can't read it maybe. That's 60%. That's 70%. There's two things I want you to see in this line. First is, for a couple of generations from the end of World War II, that line was pretty flat. It squiggled up and down, but on average, the share of total GDP in America accounted for by consumption was about 61%. An implication of this is you can look not at just the consumption of households, but their savings, how much households save out of their income. During that couple of generations, the average household in America, its savings rate out of their after-tax income was about 10%. And you can reflect, those of you who see, I'm getting older, my hair's getting gray, but think about you in earlier times, some of you in the room. how much your family saved as you were coming out of Dartmouth into the labor force, working, building a family, and that kind of thing. Then the second thing I want you to see in this picture is notice that line starts to creep up. And again, let's be clear, this doesn't matter who's in the White House, which party controls Congress. That line bumps and squiggles, but it started to rise. Up until in recent quarters leading up to the financial crisis, and during them right before it, it was above 70%. And in 2010, consumption as a share of GDP was 70.5%. The flip side of that of savings was that the savings rates of American households began to decline and decline and decline. So that for a couple of the quarters, few of the quarters in mid-2000s before the financial crisis came along, savings rates of households got down to about a penny out of every dollar after-tax income. And I see some people saying, wow, and then ask yourself, think that's healthy for families and the overall U.S. economy? So in the late 2000s, or in the late 1990s, what did people say? I don't need to save because what was going on in the late 1990s? Equity prices going through the roof, especially for .com stocks. Pets.com and mynewcompany.com, and they didn't need to be profitable, and they got $1 gazillion from investors, and it was great. And the NASDAQ closes in early 2000 at 5,048 one day. Yesterday, the NASDAQ closed at 2,500. So big run up, trillions of dollars destroyed when that bubble bursts. So the balance sheets of households take a big hit. And then in recent years, we can search and replace, and what did people talk about? I don't need to save because what's happening on my balance sheet? What was going up and up and up in prices? Real estate. Oh, my home, it's great. I bought a house. It's probably going to double in value in 6 weeks. I'll sell that to my uncle. My gardener's got a hot tip on 3 other properties. I'll buy those. Houses are totally different from stocks. And I admit, few economists knew that this stunning run-up in home prices was going to lead to as shocking of a nominal price decline throughout America and in many other countries. So we had this asset price bubble. And because America was consuming so much, part of that was a lot of things linked with residential real estate in recent years and building homes themselves. Because the amount of spending by households wasn't big enough relative to our income, we had to borrow a lot from the rest of the world to pay for this. So we had to sell a bunch of assets to the rest of the world. And in particular, in the 2000s, we were each year selling literally hundreds and hundreds of billions of dollars of assets linked to real estate. All the fancy derivatives that got created on Wall Street linked to residential real estate in America. This picture is a major reason that the American financial crisis became the world financial crisis. So my rhetorical question is, we can't just build a lot of jobs in America, Jim. If we go back to building a lot of jobs linked to retail malls and residential real estate and fancy new refrigerators and SUVs and stuff, I'm not trying to pick on particular industries, but in the aggregate, that's a lot of what was going on with this surge in consumption. We're rebuilding the basic preconditions for the world financial crisis. And what we're also rebuilding is more and more unsustainable household consumption patterns that are going to lead to great difficulty for tens of millions of households as they reach traditional retirement years. If you look at the financial planning industry, some of you might work in that industry, people have been saying for years that tens of millions of Americans are woefully underprepared for retirement, given the traditional metrics of how large your savings should be on your balance sheet to replace the income you lose for consumption as you move out of the labor force. That hasn't gone away. Frankly, the financial crisis has just made it worse. Peak to most recent quarterly data that came out yesterday from the Fed, households in America lost about $11 trillion in wealth in the financial crisis. At the trough, it was down like $18 trillion, but global asset prices have rebounded a bit. So, and sorry, here's the picture, I won't dwell on this, the run-up and then the collapse in home prices. This is the Case-Shiller Home Price Index, some of you might be familiar with. And I won't go into details, but what's striking is, for the first time in American history, we had this dramatic run-up in home prices and then a nationwide collapse in almost every major market of those nominal home prices. So, and I see some people looking, sorry. So 2 national indexes in green and yellow. Closest one to us here at Hanover, there's Boston in blue. And then some of what are called the sand states. Here's Miami in red, and here's Las Vegas. And notice nominal home prices in Las Vegas now back to 1999 levels. And the oversupply and the shadow inventory from the homes in foreclosure and stuff for a lot of markets, it's going to be years and years to get to some basic equilibrium again of supply and demand in some of these real estate markets. And I don't know how much and when. But again, Tigger run up, Eeyore collapse, and now Piglet, in part because of massive federal government intervention in the housing market still. About 95% of ongoing flow of new mortgages that get issued get touched by the federal government, either by Fannie or Freddie or FHA. So our country hasn't quite figured out how to what's the right balance for government role in housing. It's gotten deeper and thicker, not less. So the 70.5% is a summary for America needs to grow the right kinds of jobs. So they got to be jobs, frankly, linked to the global economy in particular. What we need to do is try to tap into the dynamic growth of Brazil and India and China and a lot of other countries. Because of the challenge facing a lot of American households, we can't build jobs linked to malls and home building. That's part of how we got the financial crisis. Maybe some, but we need to build literally millions and millions of new jobs linked to the global economy. Those are the kinds of jobs and incomes we need to create and the related capital investment. How do we do that? We need to have some policy leadership in part. So in today's Wall Street Journal, I have a co-authored op-ed with former Senator Tom Daschle, former Secretary of Transportation and Chief of Staff Andy Card. We've been working on a task force report for the Council on Foreign Relations, one of the organizations I'm part of. And that report is being released Monday morning. But we say America has no trade policy to speak of any kind, and we're doing nothing to try to build jobs linked to the global economy in terms of supporting American companies' ability to sell stuff in other markets. A lot of that's got to be services jobs, too. We run a huge trade surplus in things like educational services. And I'll come to that later on my fifth number. But it's software, it's educational services, it's technology, it's engineering services. We need to have a total radical overhaul of how we think about having the federal government support building jobs linked to the global economy. Because we don't do a very good job of it right now. And we can sit around and not really do anything about it, but then my January of 2020 number isn't going to budge very much. Please.
I was just going to ask, if the rest of the world is experiencing the same kind of downturn that the United States is, how could they support us by, if we're going to be building jobs based on their economies and exporting to them, how is that?
Oh, great question. That could be an exam question for my Tuck students. I love that. I'm going to remember that one. So part of it is, we can't magically fix the challenges facing Greece and Italy and Spain. So we'll come to that. Hopefully some of them are going to get better. But what it really needs to mean, it can't be the whole solution, but part of it is tapping into the growth in China, India, Brazil. For the past 32 years, GDP growth in China has averaged 10% per year. That's the size of the whole economy, doubling every 7 years. And part of where the growth can come from there, they have grown so much by exporting stuff to the rest of the world. But their government themselves says, we can't do that forever. The paradox is, in China, they need to grow more consumption, not less. You know what consumption was last year in China as a share of GDP? It was 70.5% in America. It was like 35% in China. Do you know what the savings rates of households in China are? Again, got down to about 1% in America. It's dipped up to about 5%, still well below where it was for decades after World War II. Savings rates in Chinese households, about 35% in recent years. 35% of their income they save. And the average income in China is about 1/10 what it is in the United States. Per capita income in America, about $45,000. Per capita income in China last year, about $4,500. And yet those families that are 90% poorer on average than those in America, they sock away about 1/3 of their income. That has allowed them to build their productive capacity for the future, to build capital investment, the roads and bridges. Anybody have been to China of late? The dynamism, think what you've seen. I see people nodding their heads. It's unbelievable. But we're not doing anything to try to connect jobs in America to all that dynamism. Our U.S. government did a great report earlier this year that surveyed thousands of American companies on the fact that the Chinese, in different explicit and implicit ways, are stealing a lot of intellectual property. Their companies, and to some extent the government has done it there as well. And the U.S. ITC, I worked with the folks there on this report a little bit. They tallied up the numbers and said if we could magically get Chinese IP protection levels to Western standards, U.S. standards in particular, that would create 2 million new jobs in America. 2 million. Now, you ask me, I don't know where you all live, how many of your representatives have been talking to you about Chinese intellectual property rights? I guarantee you almost none of them has. So my question is, I'm not saying our public policy should be entirely at the beck and call of corporations, but our corporations are telling us we're losing so much revenue and business opportunity and jobs in America from things like that in the world economy. That's the report, like I mentioned, this op-ed in the Journal today, says that's what we got to start focusing on. And frankly, talking about whether the payroll tax rate's going to be cut by 1 percentage point or 2 percentage points for 1 year, it's going to make a little bit of difference, but the key words are little. So, yeah.
So, if you took the median income, a person with median income in China,
Yep.
and a person with median income in the United States,
Yep.
and you looked at their expenses for major aspects of their costs of living,
Yep.
how would it look substantially different?
So it would a bit because of what economists call the paradox that haircuts are cheap in poor countries. So the cost of non-traded services like haircuts and restaurants is a lot lower in lower income countries because on average their wages tend to be lower. So the numbers I gave you about $45,000 for the per capita income in America and $4,500 in China, that's at market exchange rates. And then we can, another Tuck student question on a final. If I use purchasing power parity exchange rates, which are hypothetical exchange rates that we don't see in the real world, but that would account for these cost differentials, then the standard of living in China is a bit higher. The standard of living in China, most people say, is somewhere in the neighborhood of about $6,500 per person. Still a fraction of what it is in America, but a little bit higher. And I will stress, I spend a bit of time in China for different things. For example, for an executive education program that I help run at Tuck, and we take people to India, and it's the same qualitative thing. So many of these executives from the United States and other advanced countries, what they're most deeply impressed about in these countries is not the low costs, it's the dynamism and the effort and the sense of opportunity and the sense of hard work that permeates now hundreds and hundreds of millions of people in these countries. And I don't fault them. They have the same aspirations that a lot of you had when you were students here, that you have for your children or grandchildren now, and those of you that are U.S. citizens. And this gets to the question about my fifth number on education and stuff. Who sees that most and who I think is signaling that to America are the global companies. And the question is, what are we going to do about that to try to not just build jobs, my first number, but the right kinds of jobs, my second number, right? Please.
How do you change the consumption patterns of American families? I can understand what you're saying, but I don't see the connection.
So the question was, how do you change the consumption patterns for American families? So that is a deep and really important question. I'm an economist. I get, look, consumption, all else equal, tends to be a good thing. That's how you get utility and welfare and all that stuff. But the question that I don't hear a lot of leaders asking is really kind of what's sustainable consumption? And it's hard because incomes aren't growing, so millions of families are struggling. But at the same time, what I'm looking for are some leaders with narratives that say, you know, we're going to do things to try to build jobs. But you know, America, there was a period where people planned more for the future, and they didn't. This is Matt's view. You can take it for what you will. How would I put it? There wasn't this sense of like entitlement. I can have everything yesterday. I should have 2 big SUVs parked in my 5,000 square foot house, and my kids should get 32 Xboxes and PlayStations and Wiis. Now, that's Matt kind of winging it, but I will tell you the economists, digging in all the fancy numbers to explain this, there's a lot of this that just seems to be what economists call rise in household discount rates in America. Americans, what the data shows, they're just inherently more impatient than they used to be. They want to consume more today. And you think about your families and kith and kin that you know, and I dare say probably a lot of us, they're good people, but there's just a sense of that we see a lot in American society. And again, there's just, for a different set of cultural, political, other reasons, we are massive outliers compared to almost every other country in the world on this. And notice we're outliers compared to how America used to be. So you ask a very deep and important question of how do we change it. I don't fully know. Well, okay, sorry, yes. So if I'm handed a great policy magic wand, the great thing about taxing stuff, and you don't need fancy PhDs, If you tax stuff, whatever that stuff is, folks, businesses and people will do less of it. So if I jack up a tax on consumption, that's going to induce people to save more and consume less. In the fancy world of economics, that's called a value-added tax or consumption tax. And then depending on where you are, some people in the world will scream, socialism, because all the European countries have it. And many of them do, yep. So please, in the back.
You consume less, you're going to not need as many refrigerators and things like that.
Right, so what I need to do, or I need to link jobs then to building refrigerators, not for American households, but for Chinese households. That's the trick. That's the thing to see. And not that Americans won't ever buy anything again, but it's a matter of balance. I mean, that's the thing about economics. Like people say, well, sometimes people will say to me on this, when's the tipping point? That's the wrong metaphor. You know, global macroeconomics, there's all these equilibrating mechanisms. So the point is, I need to have a lot of companies in America, big and little, suddenly sitting around thinking about, you know what, I need to hire some new capital. I'm going to expand my plan a little bit, and that's going to be jobs linked to capital investment. Because what I want to do is I need to sell a lot of refrigerators, not down the street or in Iowa, but I'm going to actually sell them to folks in India and China. I'm going to have to think differently, and I'm going to have to hire some Dartmouth undergraduates that actually have been to those countries to tell me what it's like to be there and figure out a marketing plan. And I'm going to have to hire some smart technology people to build my website in Chinese. Those are the kind of jobs I'm talking about. And in one industry, it can't just, if we just say, green jobs, there's just not enough there. Please.
How relevant is what seems to be a blame game about regulation versus deregulation?
So the question about regulation versus deregulation, I'm not an expert on all the regulatory issues, but I am persuaded by a lot of the executives when surveyed who say that part of what's holding them back on building any kind of jobs in America is heightened regulatory uncertainty. And this is the thing, I want to stress small businesses in particular. You tell them they're going to get a tax cut for like 12 months, and they're not. Right now, all these businesses, no one knows what's going to be the payroll tax rate come January 1, despite the different proposals that have been made. So our U.S. government will spend months now debating, feuding, bickering, depending on what verb you want to choose, and probably that won't get fixed, would be my prediction, until literally the week before New Year's. And then a lot of those firms will then think, okay, that's for 12 months. And I don't know what the tax rate's going to snap back to come January 1 of 2013. And it'll depend a lot on what happens in November of 2012. It'll depend on where the world economy is. That uncertainty the economics is very clear. Chairman Bernanke wrote his dissertation many moons ago all about how you crank up the business environment uncertainty for companies. They dial down on all investments, hiring being one of them. Because as they think about the present value of those tax flows, or cash flows that they're thinking about, they have less and less certainty over it. And now I've got my views about what regulations I want to see, and I'm not saying let companies pollute everywhere and all that kind of stuff. Don't get me wrong. But there is something inherent about more and more on personal tax, corporate tax, healthcare costs, energy costs in America than there was a few years ago, and definitely compared to a lot of other countries. Okay, third number, please. One more quick question, and I'll give us a couple more numbers.
What are the political leaders that we have today making policy? Do they understand this the way you do?
Can I defer that to my fifth number? Because I got a picture on that, okay? It's a good question. 0%. 0% is a number to keep in mind that one of the things that I think governments have done a fabulous job doing to help prevent a Great Depression, but that it's still a work in progress, is monetary policy. So central banks that can print money. If you and I try to print money, you might do that for a while, but you'll get caught by the authorities. That's called counterfeiting, and most countries will go to jail. So don't do that. Yeah, I don't know. Maybe there's some country in the world where it's free banking. I don't know. That's what it used to be, right? I mean, in the 1800s in America, before we had a central currency, it's like that old Steve Martin riff, hi, I'm Fred, put your money in my bank. You could print Fred's monetary notes. Doug Irwin in the economics department is one of the world's best economic historians. I'm sure if Doug were here, he could give us some examples. He's great. So there's a challenge for monetary policy all around the world. So this is a number to keep in mind. And this gets to policymakers. The central bankers, I think, have done a fabulous job on average, but they're trying to figure out now what to keep doing. So the fabulous job was, in late 2008, central banks were being told by businesses, It's not just capital markets and banks that are going bankrupt and breaking down. We can't fund our day-to-day operations. It was the General Electric's, Jeff Immelt, Dartmouth undergrad, he and other executives going to leaders and governments around the world saying, we can't roll over our commercial paper. All our lines of credit are being pulled. We can't fund our day-to-day operations of paying vendors and making payroll. You have to do something to help stabilize the economy, or we're going to have a massive set of layoffs, much worse than the picture I showed us. And I think central bankers did, on average, a fabulous job of doing what they're supposed to do at times of crises, which is literally printing money out of thin air. That's a liability on their balance sheet, and then doing things with that on the asset side of their balance sheets to try to stabilize economic activity. And full disclosure, I worked for Chairman Bernanke at the Fed when he was at CEA. He was a member there with me before he went to the Fed, so I had the pleasure and honor of working with him a bit. But basically what they did, without going into details, is they printed trillions of dollars out of thin air, and then they bought up trillions of dollars of assets. And many central banks, the kinds of assets they never had been in the business of buying. The Fed buying almost $1 trillion in mortgage-backed securities to try to stabilize funding in real estate, and that crash in prices I was showed us a minute ago. So 0% is the target policy interest rate that many central banks slashed their goal towards by printing a lot of money. Right? Supply of money goes up, the price of money goes down. It's kind of the intuition. And the challenge, though, so the Fed's balance sheet today is about $2.8 trillion, blown up 3x from where it was before the financial crisis at about $850 million. Yeah?
Is the Federal Reserve, in your opinion, insulated from political pressure?
No, and that's a problem.
And the follow-up question is, do you think there's a potential for proposals that are currently being floated to basically put the Federal Reserve under the control of, I assume, Congress?
Good question. So I'll answer it with these two bullets, which is now what is the short answer for a lot of central banks. They're faced with the challenge of how and when they might unwind all this historic stimulus that they put in place. And so most central banks, the Fed included, faced with this trifecta of what I call technical, economic, and political challenges. Technical. At some point, I need to shrink the size of my balance sheet. I now have all these different assets that I hold that I never used to hold, special lending facilities, different kinds of assets. When and how do I sell some of those assets? Economic. Different central banks have different statutory obligations for what their goals are. And depending on the statutory goal, it's a challenge. So the Bank of England and the European Central Bank, their statutory goal is to prevent price inflation. But in both countries, the region of the Eurozone and England, inflation's high and rising. Inflation rates in the UK are like 4.5% in recent quarters. The Fed has a dual mandate. Try to maintain price stability consistent with full employment. And the basic challenge for the Fed is they look at picture number one that I showed us. That would suggest more and more stimulus of some kind, but they also got to keep an eye on price inflation. And then the political challenge is precisely that, your question, sir. Who is the chairman of the House Financial Services Subcommittee on Domestic Monetary Policy and Technology? In the House Financial Services, different subcommittees. This is the subcommittee that oversees monetary policy. When the chairman has to go testify before Congress legally, twice a year to the Senate, twice to the House, it's this subcommittee. Who chairs it? Gentleman who's running for president on the Republican side. What's his name? Not Boehner. Nope, not Boehner. Not running for president unless something changed today. Ron Paul. And Ron Paul wrote a book called what? End the Fed. If Ron Paul were elected president, he would shut down the Federal Reserve. This is kind of on the question of political leaders. I've testified before Chairman Paul on a number of occasions. I will just tell you, I think that would be a horrible policy idea. But Chairman Bernanke has to think about that among the many other things that he's thinking about. So if a picture's worth 1,000 words, right? Coach Stevens has his playbook out today, and hopefully it's going to lead to a big win. But I will tell you, there's no historical precedent for where the Fed and many other central banks are today. There's no playbook to look at. The Bank of Japan has been struggling with this for 20 years. No disrespect to the people of Japan, but in some broad sense, some of the things that we're talking about today, our goal in the United States and the goal of many other advanced countries is to avoid being like Japan. Japan has had almost no economic growth for 20 years. They have had grinding asset price deflation for 20 years in equities, in commercial real estate, in residential real estate, in land. The Nikkei stock index in early 1990 closed at about 40,000. Where did the Nikkei stock index close yesterday? About 8,500. So a secular grinding bear market of 75% for a generation. And unemployment today in Japan is higher than it was in 1990. They've never gotten their labor market back to where it was when their bubble burst. So that's the goal that Chairman Bernanke and a lot of other central bankers are trying to avoid. Please.
So we've got one more issue here, which is the reduction of debt.
Yep, so that's my fourth number. It's a big one. It's not little. It's $4 trillion. So this number speaks to the challenge of, it's not just policymakers with monetary policy, it's the fiscal authorities, the folks that raise the taxes and decide how to spend it in the US and other countries. And my number here is to say, in case you guys haven't noticed, we're running really, really big fiscal deficits in lots of countries. And the US data for fiscal 9, 10, and 11, if I add up the deficits those 3 years, I get about $4 trillion. We don't yet have fiscal 11 because it closes at the end of October, at the end of this month, so it's got a couple more weeks for fiscal 2011. But it'll be about $4 trillion. Taxes as a share of GDP now only about 15%, spending as a share of GDP about 25%. But for a few years in and around World War II, a lot of these types of numbers we've never seen in the history of the US Republic. That's sobering. And I'm not saying we could talk about fiscal stimulus and good idea, bad idea. But you should know this spending made things a little bit better than it would have been otherwise. That's the right answer. Now, we can quibble about whether 1 million jobs were saved or created because of the stimulus, or 1.5 million. Nobody really knows. It's all models and counterfactual guesses. They're educated guesses, but they're guesses. But if the federal government had done nothing to raise deficits, my picture of the labor market, I guarantee you, would be worse today than what we actually have. Now, the question, though, going forward is that, it's going to get worse. Meaning, the coming handful of years of this decade we are now in, we're going to probably meander along with several $100 billion or $1 trillion deficits for the next 10 years. That's my best guess, and a lot of private sector and other forecasters. So we'll get to 2020 where debt as a share of GDP will have risen from about 70% up to about 90%, maybe 100%, depending on what forecast you want to play with. But the reality is that's when the fiscal pressures facing America really kick in, because of the interaction of an aging population and the rising demographics of increased healthcare costs per person and per expenditure. So the present value shortfall of Medicare, Medicaid, and Social Security today, the kind of actuaries that look at the numbers and try to, in present value terms, forecast all the revenues and then all the outlays, that shortfall is like $50 trillion. And I kind of chuckle because I'm like, okay, I'm a baby buster. I'm on the wrong, despite my gray hair, I'm way on the wrong side of this demographic divide. And I'm like, everybody's known this. Smart people have been giving speeches about this even before the financial crisis, because it's just a matter of actuarial tables. And the Dartmouth Institute, one of the many great things about Dartmouth, TDI, world famous for putting out data on documenting just the ongoing grinding increase in healthcare costs. And regardless of what you think of the healthcare legislation that was passed last year from ethical or whatever perspectives, there's very little, if anything, in it that has a firm way of trying to slow the rate of growth of healthcare costs. So we all kind of need to hope for businesses and for the government that we can slow the rate of growth of healthcare costs. In the jargon of economics, get more productivity growth. And one of the great things at Dartmouth that's happening right now, actually, is TDI and Tuck, we have partnered to start a new master's degree in the science of healthcare delivery. President Kim, one of his initiatives was helping provide the vision for that. That's really exciting. You got to start where you can. That's first cohort's about 50 students. Practicing docs, head of hospitals and stuff coming in to try to figure out in different ways how to make that number not be as big. But it's learning, and it ain't scalable today. So that's challenging, and this is global. So I've listed Ireland, Greece, Iceland, UK, Portugal, Spain, Italy. I could have put Japan on there. Japan fiscal debt as a share of GDP today is about 200%. And the question is, how's all that going to play out? Quick question?
Isn't it possible that the standard of living of America is not sustainable given the competitiveness of our workforce and our economy?
It's possible.
Isn't that the bad news that no one wants to tell us?
The bad news, remember, I told us this, average household income in America today is $369 higher than where it was 22 years ago. I mean, we're kind of already there. And this is part, when you ask about leadership, I'm still waiting for some leaders, because a lot of Americans get this when they're sitting around their kitchen table. But some leaders do at least acknowledge, without saying it's the darn Democrats and the darn Republicans, say, look, we can talk about how we got here, but this is where we are. You guys know this. The average family, their income's increased over the past generation by about $15 a year.
Is there any example where you could legislate prosperity? My view has always been you can't legislate prosperity.
No, you can't. I mean, you can aspire to it, but it's always been true for any country. Economic development, you can't pass a law or some mandate and have it happen. It just doesn't happen that way. So, on this happy number, governments can only do so many things. If they want to spend more today than they take in tax revenue, there's only so many things they can do. They can hold a debt auction and hope that private creditors show up and buy the debt. They can get transfers from taxpayers in other countries to make up for the shortfall. They can sell debt to their central bank. That's a fancy way of saying printing money, and that tends to be inflationary in the long term, and it can lead to hyperinflation, if you look at Zimbabwe a few years ago. Or they can default. And what's playing out in Greece in real time, and Portugal and Ireland and increasingly Spain and Italy, is it's just not clear that how all these sovereign debtors in Europe are going to make themselves good without defaulting partly. And that's the crisis that's playing out in Europe in real time. A lot of these countries, their fiscal situation is horrible because of how their governments have blown up their deficits to try to compensate for the private sector damage in the world financial crisis. That's the proximate cause. Some other countries like Greece, there's just been secular imbalances building for a long time. Nobody paying, hyperbole, few people paying taxes, lots of graft and corruption. Greek government officially lying to European statistical agencies for years. And so many of these countries now are illiquid. And so the European Central Bank is printing money and buying their debt to allow them to function day to day. But the concern is that illiquidity is rapidly shifting to insolvency. And how that plays out, no one knows. And why it might become a financial crisis is because a lot of the banks in Europe hold a tremendous amount of this sovereign debt, and the regulatory authorities don't have a good idea on how damaged the banks might be if the sovereign creditors have a partial or larger default. So what's happening in real time is not a run, but a walk on a lot of the banks in Europe right now. This is happening this week. You see it in a lot of the spreads. This is why a couple of days ago, a lot of 5 major central banks around the world said we're going to make huge loans to these banks that need it for short-term funding. Because what we saw in the financial crisis with Lehman and Bear Stearns, runs now happen not from individual depositors running, like in the Mary Poppins movie where Michael triggers a run on his father's bank with the tuppence. Now it's other private financial actors running because they don't provide the short-term lending to these financial institutions. And they pull back on rolling over the commercial paper. That's happening slowly to several banks in Europe. It's happening slowly to some of these sovereign creditors. And unless somebody prints enough money, the European Central Bank has been printing money, but grudgingly and with open hostility. Two major European Central Bank officials have quit in the past several weeks. It's a slow-motion financial crisis, and it's just unclear how they might be able to stem the walk before it becomes a real run. And I know you guys are like, God, I'm glad last time I go to a chalk talk, these numbers aren't happy, but this is just a real thing right now that's playing out in real time in Europe. And Italy and Spain in particular have a major amount of sovereign debt coming due in the next 6 to 8 weeks. And depending on where the overall confidence is or is not in the European financial system, that may be a real trigger a lot of people are concerned about. At some basic level, the question for Europe is whether relatively stable and wealthy countries like Germany are going to be willing to transfer tens and tens, if not hundreds of billions of euros of their citizens' taxpayer money to countries like Greece and Spain and Italy. That's a political choice for those countries. I have no idea how it's going to play out. Your guess is as good as mine.
Is this comparable to too big to fail as we saw it 3 years ago in this country?
Italy is too big to save. Italy is the third largest sovereign creditor on the planet after the United States and Japan. The total stock of their outstanding debt is the largest after the U.S. and
What are the consequences then of letting one of those sovereign debtors just go into the tank?
Reasonable people have wildly different opinions about this. Some people say let them default and incur the cost. Some people say that might make you feel better if you think it's fair, but it's going to trigger another world financial crisis. And by definition, nobody knows. So and the other thing these sovereign governments are dealing with is civil unrest. I mean, you just read the news in recent weeks and months. There's part of what these governments in Greece and stuff are dealing with is all the financial stuff, and then they pause to reflect and they look out their window, and literally metaphorically, there's thousands of people screaming in the streets and protesting and riots and water cannons in Athens, in Madrid. And where was this? Is this Madrid or Athens? That's University of Wisconsin, State House there. So we in the United States our leaders, this is getting leadership, and sorry, I'll be done in a minute, we're looking at all this happening, and the underlying demographics and political process for America suggests it, I hope not, but it may come to America. Neil Ferguson is this eloquent, thoughtful financial historian at Harvard University, and he's written some provocative things of late saying, well, I just think it's a matter of time before a debt crisis comes to America. Do I hope that's the case? No. But remember, Standard & Poor's downgraded U.S. Treasury securities last month from AAA, what everybody thought was the global risk-free asset, to AA+. And part of what's happening in capital markets is a lot of actors are sitting around saying, I always thought one of the constants in the universe, in addition to the speed of light, was no default risk for U.S. Treasury securities. Its speed of light is still the same as it was last month. The sense of fallibility of Treasury debt is now different. And what S&P hit on was the broken political process in the United States. That's what they said in their analysis. They think that what will threaten the credibility and payment probabilities for the U.S. government is not the underlying economics so much as the broken politics. Right? And that gets to my last number, which is 75%. 75% is this is a number that just points out we've got these kind of crisis issues, right? What monetary and fiscal authorities are struggling to do, the hole in the American labor market. But all this, I've kind of touched on this in different ways here, all these pressures are building and are present on top of a set of kind of what I call lower frequency secular pressures that were building in the United States well before the financial crisis. And some of you have called this out. This is a number about America's educational problems. So my point is, and this is opportunity still, but we've got to figure out deficit, monetary policy, trying to build jobs and stuff today in an environment where we have had problems and challenges building in America well before and independent of the financial crisis. And here at Dartmouth, I'll point out the educational one. America over the 20th century, part of what made us great economically was the average educational attainment of its citizens and workers grew dramatically. That largely plateaued in the past 40 years. I was born in 1969. In 1969, the high school graduation rate in America was 77.1%. And per my fifth number, this will be an easy exam question, what do you think the high school graduation rate was in America last year? About 75%. The high school graduation in America in 1900 was about 5%. And then with the spread of secondary education through law, the public funding for that, public schools just ratcheted up dramatically the graduation rates for high schoolers in America over much of the 20th century. It hit 77.1% the year I was born, and it's been basically flat since. College completion rates in America have completely stagnated for males. Not so much for females, but for males. So if we wander on campus today, I don't know if anybody knows the facts, and I don't know if my Dartmouth colleagues do, but I dare say the entering class of the 15s, there's probably, in share terms, a little bit more women than men. That's true for most American colleges in America today. That's bad, I think, for many reasons. But again, what matters is not just what we're doing, but because of globalization, what we're doing compared to the rest of the world. So in the rest of the world, all our skill upgrading stopping happens at a time where so many other countries have been building up their educational systems. Today, among industrialized nations, we're 16th in college completion rates, 20th in high school completion rates. We used to be, you go back 20, 30, 40, 50, 60, 70 years, we tended to be at or very near the top of all these things. And there's an international organization that every 3 years does a really good ranking of 15-year-olds. They get a stratified random sample of 15-year-olds in 65 countries. And U.S. students in 2009 were 15th in rating, 23rd in science, 31st in math. Who was number one in all those categories? China. And then people say, oh, time out, it's just metropolitan Shanghai. To which my answer is, how much of a leading indicator do we need in this country? Okay, it's just metropolitan Shanghai, which is about 25 million people, larger than most European countries we've been talking about. And one of the most sobering things when I take these executives to China for this program that I mentioned, we take them to a rural village a handful of hours outside of Shanghai, and we take them to a school, and they see these kids with flat screen TVs learning English starting at age 6, going to school 6 days a week. So China, China, and China. And it's education, but it's other things. What does the government do in terms of running business? Our country's struggling to figure that out in the wake of the financial crisis with the bailouts of not Ford, General Motors and Chrysler. Our infrastructure is crumbling, literally and metaphorically. The American Society of Civil Engineers gave a grade of D to the quality of overall American infrastructure. I call this the planes, trains, and automobiles test. Think about the airports you fly through and the quality of those airports in America, especially if you're coming through customs. And you go to airports like that in Shanghai. The Shanghai International Airport just opened a couple years ago. It's mind-blowing. Yeah, it's beautiful architecturally. It's clean. It's efficient. You get through customs in like 2 minutes. And we used to be really good at being open to the rest of the world, and we're closing up in lots of different ways on that. We at Dartmouth, there's some of us trying to help inform these policy conversations, and this gets to the questions people ask about leaders. So I'll just point out for those of you that are alums, I have a colleague at Tuck, Ken French, and Ken and I, in the wake of the financial crisis in fall of 2008, got together a group of 15 academics, including ourselves, on Squam Lake. And Dartmouth's Minari Center, we used to be there. It's still there. Dartmouth doesn't own it. But we got them together at Squam Lake and said, hey, let's try to speak as one collective voice to try to provide some guidance to regulators about financial regulatory reform. And it ended up being a book that we wrote, and we spent a lot of time with people like Barney Frank, who came to campus here yesterday to Tuck to give a talk. I've worked with him over the years and some others. So a lot of the faculty at Dartmouth that work on these kinds of things in economics and finance and healthcare, different areas, they're very active in different ways based on their scholarship or their teaching. But, I don't quite, where's the leadership going to come from? You guys know as good as I. So my last thought, and I appreciate you guys, sorry, I ran over a little bit. Here's a picture. This is a picture of September 29th, 2008. It's the leadership of some of the House of Representatives. It's the evening of that evening of September 29th. Why did they look so glum? What happened that day? What did they vote on? They voted on the TARP that day, the request to give $700 billion to try to stabilize the financial system. And did the House of Representatives vote it up or vote it down? The initial vote, they voted it down. And they're looking so glum because as this was playing out in real time on TV, as markets watching C-SPAN and CNBC and stuff realized that they were going to vote it down, global equity markets collapsed. The Dow closed down, I think it was 777 points that day, the single largest point decline in American history, about $1 trillion in market cap destroyed in about 90 minutes. And so a lot of people then in the world said, oh my God, it's a really bad situation, and the leadership in Washington, D.C., they're all pointing partisan fingers at each other, and they can't kind of do some things that they probably need to do to prevent a Great Depression. So about a day later, the Financial Times ran a big analysis piece, and its basic theme was, is this sunset on the American economic empire? And I'd work on these things, and I worry about them, and I read the piece, and this picture was in that piece, and I said, I worry about that. And it's a very lovely picture. You're standing on the steps of the Lincoln Memorial. If you stand where Martin Luther King gave his I Had a Dream speech, they get the words there. And you're looking down the mall. There's the Washington Monument. The White House is over here, up to Capitol Hill. And I've spent a bit of time in Washington over the years, and then I was kind of like, actually, that's standing there, and you're looking down the mall east, not west. That's sunrise, not sunset. So then I knew the guys at the FT that wrote this piece, and I said, by the way, from a good American in the country that beat you in the Revolutionary War, I said, be a little careful, Maybe this is going to be one of those times America really, times of crisis, leaders oftentimes step up. So maybe. But the question is, we don't yet know, I don't think. And if you look at Americans today, do they feel like it's more like sunrise or sunset? Sunset, I'll tell you. Do you feel America is in a state of decline, or do you feel that's not the case? 2/3 of Americans think we're in a state of decline. These are recent public opinion surveys done by the Journal, the Washington Post, stuff like that. Do you feel confident that things will be better for your children's generation? One of these big thermometer questions. If you look back at previous recessions in America, even coming out of those recessions, it was still the case that a few more Americans felt better about the future, even though we just had a recession. Today, no. 2/3 say they're not confident things will be better for the kids in America. And that's because they look at what's happening. They see what's happening with their pocketbook and stuff. Is America on the right or wrong track? 77% of Americans last week told the Washington Post they think America's on the wrong track. Oh, 77%. So here's a quote from Pete Peterson to wrap it up. Great business leader. I hear this from, I know Mr. Peterson a bit, and folks like him who say, I've never seen the challenges so big in America. And yet they say, I've never seen leadership from the private sector in part so absent. You can talk about whether we think the public sector as well. So they say kind of where's the leadership going to come from to address these things for our kids and our grandkids? And the question is, I don't know. You know, we got a lot of challenges. We got to create a lot of jobs. There's a lot of policy challenges that America and the world face, that if we get it wrong, things are going to be really bad. But despite these 5 numbers, and I appreciate y'all taking the time, is I want to stress the Tigger point I made at the outset. For all the students on campus here today, the Tuck students and the Dartmouth students, you know, we and the Dartmouth faculty and the Tuck faculty, we're trying to get our students to actually see this as an inspirational opportunity. You know, they've done great things to get here on campus, and they can go out and do great things because, frankly, the world's going to need them to do it. It's hard. It's not, you know, I wish I had the magic wand to erase all these numbers I showed us here, but it's a real opportunity for all the students that are on campus. And that sort of balanced, you know, kind of here's the reality, but yet let's get inspired by that and go out there and do some things. That's hopefully what, it'll be Dartmouth, but a lot of other campuses in America will be creating, right? So welcome back. Enjoy the weekend. Thank you. I ran a little over. I'm happy to answer any more questions, but I want to turn it over to Roberta. Thanks, everybody.